Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. Geopolitical tensions, domestic headlines, currency flows, and the Fed have reignited that whole U.S. versus international investing debate. So joining me now are John Mayer, the chief ETF strategist over at J.P. Morgan, alongside Tim Seymour, the chief investment officer at Seymour Asset Management. He is also a CNBC contributor. Gentlemen, thank you both for being here with us today for ETF Edge. Perhaps, John, I'm going to start with you on a little bit more about this kind of global ETF trend that we are seeing develop. There's a lot more focus these days on that international and global side of investing than there has been over the course of the past couple of years. What exactly in your mind has been driving a lot of that renewed interest in those international markets?
Well, first of all, it's just been a record-breaking year, 2025 for ETFs overall. So let's put that out there. Over 1,000 new ETFs launched. 83% of those were actively managed. The U.S. trading volume reached $58 trillion, which was 1.25 of the previous record. So flows into ETFs have been very strong. Last year, $1.4 trillion. After record-breaking 23 and 24. So that continues on. Now, this year, you're hearing lots of conversations about metals. There's been a metal frenzy. That certainly plays into possible weakening of the dollar debasement. Flows this year last year exceeded $216 billion. That's over 100% increase if you combine 23 and 24. And our own Dr. David Kelly anticipates further room to run for international. There's AI, lower interest rates, shareholder-friendly policies. These are all providing tailwinds and a weakening dollar, of course, where this is leading investors to diversify their overall portfolios that have been previously U.S.-centric portfolios. Still lots of flows into the U.S., but this diversification is something we are seeing. Is certainly following strong performance.
So, Tim, I'll turn to you with this question then. How much of what we're seeing right now with the renewed interest in international markets has been because of this performance catch-up that we've seen in just the course of maybe the last 6 months to a year or so? And how much of it is due to the fact that there are fundamental drivers behind the economics in these foreign-type companies versus their U.S. counterparts? What exactly is the reason why we are seeing this kind of move higher, outperforming in international markets versus the U.S. as of late?
Yeah, so first of all, great to be on ETF Edge. And, this kind of a conversation, we could have been having this conversation 5 years ago. And if we were talking about a catch-up trade, the catch-up would be that global markets had really underperformed. So to me, there's no question this is not people saying, oh, boy, this is a time to trade global markets. Because if you're investing in the ACWI ex-US all-world MSCI, for 10 years you underperformed. And you underperformed by almost 60%. So now in a 14-month span, really since Thanksgiving of last year, when we started to see this bottoming, you've seen international outperform the U.S. by about 16%. It's been about 5.5% since Thanksgiving of this year, but 15.5% from Thanksgiving of last year. You're still down 55% on this trade on a 10-year look back. So to me, this is about fundamentals. This is about the oxygen that was choked out of the market cap dynamic of the U.S. Mag 7. This isn't saying go sell those names. This is saying that there was a generational dynamic going on, and maybe we would have said this at the start of 24. We definitely were saying this at 25, but at the start of 26, and it's a big week of earnings and some of the biggest companies in the world, but you can make an argument that we really have started to see that stall. They're still going to be the biggest companies in the world. They're still going to have growth that should be exciting to investors. But I just think that market cap move, that choked off a lot of international investing. I would also just say that international investors in the U.S. Got very overweight the U.S. for those reasons, and they were chasing some of this high growth. And U.S. investors got very overweight U.S. on a relative basis to what they historically had internationally.
Now, when you say overweight and underweight, Tim, could I get your thoughts there about whether or not that overweight, underweight aspect of things applies to the U.S. investors out there who are looking at whether or not they should be adding international global type exposure to their portfolios. Do you feel as though, Tim, that there is an underweight or overweight aspect to what's already in allocations here in the U.S. in terms of its investors?
I think this is a long tail trade, much as I just described. This has been taking place, this underperformance, for a long time. So I think U.S. investors are still underweight. I manage an international ETF that may be self-serving, but I would just look at the numbers. Especially when you consider that global assets are roughly 30 to 40% of global market cap, depending on how you want to look at it. And I would argue that U.S. investors are probably somewhere between 12 and 15% at the high end. And different demographic groups have much less exposure. So to me, this is a story of, I would argue this is a valuation story, but it's always been relatively cheap to the U.S. It's a dividend story where divs are significantly better internationally, but it really is a story of where global growth has picked back up, where you have, this is a controversial statement. I would say deregulation in Europe is a more powerful trend than it is even under the Trump administration, because it's all about a relative change from where you're coming from. We all know Europe's been bureaucratic. We all know that these economies have underperformed. They've lacked innovation. I would make an argument that what you've seen for European money center banks is what's made it such a great investment. By the way, you've been a great run for Citi, Bank of America, and JP Morgan. It's been better for Barclays, Santander, and SocGen at a much higher div. So I think there's a fundamental story. There's this deglobalization thing that's going on. It's a bit ironic, right? That people are actually looking at the world, but the news flow over the last week, whether it's India and the European Union cutting a big deal, whether we see it's Canada suddenly cutting big oil deals with China, the rest of the world is repositioning as well. So some of this is the geopolitics, some of this is just a long tail trade that had underperformed, some of this are true fundamentals, bottom up valuations, companies like ASML or Taiwan Semi that are two of the biggest, most important tech companies in the world that happen to reside outside of the U.S. So I think it right now is the early stage of what has been a reallocation and investors saying, yeah, I'm probably underweight, and that I can get exposure to gold and I can get exposure to precious metals and technology and re-rating of banks and utilities trade and data center. These are global trades, not just U.S. trades.
Now, John, an interesting point that you brought up before was just how much of the growth in the overall asset management business, and specifically with regard to ETFs, is around active management. We've seen a lot of issuance here of new types of securities tracking actively managed portfolios. One of the places that we are not seeing as much of that in terms of U.S. exposure is in the international markets. Here you kind of buy these country ETFs or these kind of stock market index ETFs that track certain indices around the world. How far out do you think we are until we see a massive kind of move towards actively managed or actively engaged portfolio management for global markets in an ETF format, as opposed to the traditional mutual fund type international investments that people have made in the past?
Yeah, that's a good question. And active ETF flows in the U.S. hit $470 billion. That's a 60% increase from 2024 and 2025. Active ETF flows make up approximately 32% of all flows in the U.S. Last year. That's pretty phenomenal. There's, as I mentioned earlier, 80% of the funds that were brought to market last year were actively managed funds. You are seeing a lot of issuance from active managers bringing all sorts of funds to the marketplace, including international funds. And we are seeing a meaningful amount of flows into those funds. For example, we have Jive, which is an international value fund that has had almost $1 billion of net flows last year. That's a pure international value exposure with an approach, contrarian methodology to capture opportunities while avoiding value traps, looking at valuations. We have another fund, Jade, which is an emerging market fund. This is a core EM allocation. So providers like ourselves and some of our competitors are coming to the marketplace with international funds. And that's certainly a trend going forward. We're just seeing a ton of activity in the actively managed space as new competitors get into the marketplace, because I believe that's the next iteration of the ETF marketplace.
John, if I could follow up on that really quickly, you mentioned some of the funds that JP Morgan manages and whatnot. Are you seeing any interest from your clients specifically about certain geographies or locations that they're keying a little bit more on these days? Are there certain parts of the world that your clients are asking a little bit more about? Where exactly are the kind of hotter spots that you're seeing with regard to global investing?
Overall, we are seeing Europe. There's a lot of interest in Europe, particularly with some of the lower interest rates. So European exposure, emerging market exposure as the dollar weakens. And as investors are reallocating their portfolios to not necessarily chase returns, but realizing that there is a market shift going on, and that not being exposed to international markets, whether there's somewhat of a regime change going on, would not serve your overall portfolio. So EM, developed international markets, are certainly areas of interest to our clients.
All right, Tim, I saw you kind of nodding and engaging with that as John was speaking right now. So if I asked you that question, where exactly do you think those hot spots that are popping up are and will be in 2026? What would you say? What types of locations? And I'm sure these days, given the thousands of ETFs that are out there, you could probably find an ETF that tracks one of those hot markets.
You can. And Dom, I've been investing in global markets since before you were kicking the slats out of your cradle, as they say. So in other words, to me, these are markets that I've been following, and it's been interesting. I've known them as an emerging market specialist. I've known them as a global equity specialist. IDEVO, which is the ETF that I sub-advise and I'm a portfolio manager on, we're basically trying to track, and we are active, the MSCI All World ex-US, or ACWI, and we also have essentially an option overlay. So there's actually really a focus on a distribution yield. So we're trying to find companies that are growing their payout levels, that pay high divs, or have again, the delta on that increase is really exciting. But at the same time, we're also trying to stay true to international investing, but with an active tone. So we've been overweight gold for 2 years. We were very underweight China until we really started leaning into the China tech trade. Once we felt that China macro, I even mean the economy, but I mean the political kind of pressure and corporate governance risk for Chinese companies from their own government, had improved a lot. So that's meant being overweight Alibaba. But at the same time, a Taiwan semi and owning Taiwan and owning the chip sector is I think, again, part of just understanding that investors want exposure to all these trends. But ultimately, you asked about the geographies. And to me, what's fascinating is you're seeing real outperformance in places that we hadn't really expected. So Latin America has outperformed this year, and no surprise when we talk about gold and copper. So Peru's up 25%, EPU, Chile, ECH. These are places where some of the biggest copper deposits and mines and gold are mined from. EWZ, Brazil, has also outperformed. It's probably up 18-19% as of today. Some of this are the dynamics around commodities, but some of these are the dynamics around the geopolitics. Latin America, and Brazil's the largest economy in Latin America, is starting to shift a little bit to the right. And that's very bullish for those equity markets. So, to me, it's about finding the places like South Korea. EWY is the ETF, the country ETF, a country ETF. And all we talk about is what is going on in high bandwidth memory and the biggest memory companies in the world. And as semis have stalled a little bit, memory's still been on fire. Hynix and Samsung are the two biggest players in the world, if not two of the three biggest players in the world, and they're 46% of the Kospi. If you buy the EWY, you're getting great exposure to that. We own the EWY, and we have owned it in the context of, hey, if we want to get exposure, by the way, in a U.S.-listed product, which isn't going to take local exchange risk, because that's another thing from the ETF wrapper, that we really want our investors to have that comfort, that we're not going to get lost in liquidity places. So owning an EWY really gives us that trade. So I think it is a exciting time for international allocation for investors because the vehicle's available to do it. are there. If you want to focus in on a specific region, there's no question, because you're getting into some of those sector thematics. Some countries are really well known for those dynamics. And again, IDEVO, we're kind of go anywhere, best ideas, and it's about 70% developed versus 30% EM. I think that's the right mix for investors. I think a lot of investors don't want to reach too far out into the risk curve. I'd rather be in traditional big global companies with great balance sheets.
John, one of the big themes, of course, in investing overall has been the tech trade, AI specifically. That AI trade is also going to, at some point, work its way globally speaking with regard to the next hotspots. We know that in many Asian markets, we have markets geared towards semiconductor companies, tech supply chains that are going to be critical for this AI trade going forward. Do you feel as though, John, that tech and AI kind of intersection with global markets is going to lead to perhaps some of those outperformance elements in certain key geographies around the world? And if so, what do you think those particular geographies could end up being? Is it going to be Asian supply chains? Is it going to be AI adoption and data center build-outs in Europe? How does that play out from a macro perspective in your mind?
Yeah, no, I think the AI story is certainly broadening out. I think international markets are certainly benefiting from the AI story, and there's tangential intersections with AI. There's energy production. Obviously, there's data centers. There's the broadening out of production of chips and how AI can actually improve efficiencies. So that's all filtering into both international companies as well as other companies that are adjacent to the AI trade. And also in Europe with some of the fiscal stimulus, that's certainly a tailwind that's going on in Europe. A weakening dollar is certainly a benefit to European companies and certainly to international companies in the U.S. as well that have a large amount of their sales outside of the U.S. I think some of the geographies that certainly will benefit is some of the Asian countries, South Korea, China will certainly be a beneficiary, but also there's beneficiaries in Europe as well because of that improved efficiencies. They're going to take advantage just like everybody else because that is the trend, and we are seeing CapEx playing out, and that's going to continue to cause innovation. So I think the European story, the Asian story, the overall global story will certainly continue to run this year.
All right. Tim, if I was to ask you what you think, in your mind, the biggest trend in international investing will be in 2026, what would it be, and how exactly do you express that view?
I think it's underappreciated that there's actually EPS growth in places where we've seen a lot of stagnance. So I just think, again, the bottom-up earnings dynamic, especially in places like Japan, where we've had a real focus on corporate governance, a real focus on paying out free cash flow, a real focus, frankly, on efficiencies. This has been going on for 10, almost 15 years. I like that dynamic and that backdrop in Japan. I do think the industrial defense spend, so the entire world is saying we need to have fiscal spending to support additional defense. That, to me, is a trend that is very important around the world. I love the utilities trade around the world because just like the U.S., everybody is short power other than probably China. That's a place where whether you're owning RWE in Germany or Eni in Italy, I mean, these are some of the biggest utility companies in the world that have modernized. They're not necessarily, they may be large European companies, but they're not big, sloughing, bureaucratic, inefficient places anymore. So some of those same trends, I want to be long some of those same trends people love in the U.S. because I think even in a world that is deglobalized, what it's doing is it's shining a bright light on global companies that have massive businesses in their backyard. And also those companies, and John referenced this, and I referenced it earlier with that EU-India pact. I mean, there's no question Europe is doing more business with Asia. China is using the U.S. dynamic of trade tariffs and at least some discomfort in terms of what U.S. trade policy is to try to cut new deals with the rest of the world. India, for sure. So I think investors want to stay attuned to some of those same themes that are continuing to evolve. Last year's trends may not be this year's, but I think the deregulation trend is making international markets that much more interesting. I want to be in places where I think companies actually have the tailwind of a government that really needs to see them as national champions. So the strategic kind of element, again, we see that in the United States. We see that even with companies like Intel. So I think if you are Germany, you're going to make sure that your national champion companies, even if they're not called that, but whether it's Siemens or SAP or Mercedes-Benz or Deutsche Bank, I think these are trends that are alive and well.
Or Rheinmetall on the defense side, on the defense side of things as well. John, I'm going to conclude things with you. If you, as an ETF strategist and one that has the vantage point from where you are at JP Morgan, what exactly does excite you the most about what's going to happen with international markets and investing in 2026?
Well, first of all, when you're choosing an ETF, particularly in some of these international markets, I believe an active manager makes a lot of sense. Now, when you look at JP Morgan, for example, we spend $1 billion on PMs, research, technology, and that spend is only going to increase. So looking at an ETF that leverages technology, leverages the deep bench that we have as an experienced manager, both in international as well as US markets, is where you want to place your bet. How can you effectively analyze all these different companies? A passive index typically is weighted towards a few top names that often drives the performance, but you could have a strong opportunity in a value exposure by having a PM that's looking bottoms up at these individual companies, not trying to avoid value traps, is really important. So active management is only going to be important and continue to grow in terms of assets. And as the ETF marketplace continues to evolve, you'll see that more and more investors are using active ETFs and putting them in their portfolios.
All right. John Mayer, head of ETF strategy over at JP Morgan Asset Management, thank you so much. And of Tim Seymour at Seymour Asset Management, thank you as well. We've asked Tim to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching, and we'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.